So between 1960 and 2024, Pakistan pulled off what is basically an agricultural miracle.
Right, a total transformation of their farming output.
Yeah, exactly. I mean, if you look at the raw data, they multiplied their crop production index from roughly 17 to over 113. It's a historic, completely landscape-altering harvest.
Which sounds incredible on paper.
It does, but if you walk into a rural health clinic there today, you're going to find a reality that just completely shatters that whole narrative.
Yeah.
Because nearly 40% of their children under the age of 5 are suffering from severe stunting.
Yeah. It is, it's a really jarring statistic to look at.
It's mind-bending, and that's what we're looking at today. We are going through a mountain of data, and it all circles back to one impossible question for you, the listener. Like, how does a country double and triple its food supply, engineer a massive digital revolution, and yet still biologically starve the future of its population?
Well, it's the ultimate structural paradox, right?
Yeah.
You have an economy that is sprinting towards modernity on the macro level, while the absolute bottom line indicators of human survival are just struggling to even stand up.
Welcome to another deep dive. Today, we're taking you through a massive, comprehensive data set tracking the economic, infrastructural, and social trajectory of Pakistan over a 64-year period.
And we are pulling from some very heavy-hitting sources for this. We've got data from the World Bank, the IMF's balance of payments statistics, the UN population prospects, and the International Telecommunication Union.
Right, and our mission today is to really move past those glowing macroeconomic headlines. We want to use this raw data to dissect what we are calling the paradox of growth.
And this isn't just a localized story. It really isn't. This data set is basically a masterclass in reading the silent warnings that get hidden inside global development metrics.
Totally. If you want to understand emerging markets or just learn how to spot when top-line statistics are masking a crisis on the ground, this is the framework you need. So let's start with the mirage itself.
The top-line growth.
Yeah, because it is genuinely explosive. If you isolate just the macroeconomic indicators from 1960 to the early 2020s, you are looking at a textbook case of rapid modernization.
Oh, absolutely. The sheer volume of the expansion is staggering.
Right. The gross domestic product, in current U.S. dollars, leaps from around $3.75 billion in 1960 to well over $300 billion in recent years. And their per capita GDP, using 2015 constant prices, climbed from about $413 to over $1,000.
And accompanying that raw GDP growth is this profound structural shift in the economy itself. I mean, back in the 1960s, agriculture accounted for a massive 43% of the nation's GDP.
So it was overwhelmingly an agrarian economy.
Exactly. The vast majority of the population was tied to the land. They were dependent on seasonal monsoons, traditional farming methods. But as we move toward the present day, that 43% share drops down to around 22%.
Okay, which means the center of economic gravity shifted. But agriculture didn't shrink in absolute terms, right? Because we just talked about that massive crop boom in the interim.
No, it didn't shrink at all. That is a crucial distinction. Agriculture grew significantly, but the other sectors of the economy, like services and industry, they just grew exponentially faster.
Right.
And this is exactly the structural transition that developing nations strive for. The theory is you want to move your workforce from low-yield subsistence farming into services and manufacturing.
Because those sectors typically offer higher productivity and higher wages, right?
Exactly, which ultimately elevates your gross national income.
Okay, but even with that shift away from farming, the agricultural yields themselves went through the roof. The data on cereal yields, so specifically wheat, rice, corn, it shows a jump from around 856 kilograms per hectare to over 2,400 kilograms per hectare.
Yeah, nearly tripling the output.
It's wild. I know that's the legacy of the Green Revolution in the 1960s and 70s, but walk us through the mechanics of that leap. I mean, how do you actually triple the output of a single hectare of land?
Well, it required a complete overhaul of the agricultural ecosystem. It wasn't just about, planting more seeds. It was about planting entirely different biological organisms.
Wait, really? Like engineered plants?
Basically, yes.
Oh.
The introduction of high-yield varieties of wheat like the Maxi-Pack strain and these new dwarf varieties of rice, they fundamentally changed the math. These plants were bred to respond really aggressively to chemical fertilizers.
Oh, I see.
Yeah, and instead of pouring their metabolic energy into growing tall stalks, which would just fall over in the wind, they poured all that energy into producing grain.
But they also required massive amounts of water to do that, right?
Huge amounts, which meant expanding the irrigation networks, sinking tube wells all across the Indus Basin and essentially industrializing the soil itself.
Okay, so on paper, when you look at that 43% to 22% structural shift alongside a tripling of crop yields, it really signals that the country successfully modernized its foundational sectors.
It looks like a resounding victory.
It does, but when we look at this balance of payments data from the IMF, there's a massive anomaly in how this economy is actually funding itself. Because you can't just look at what's happening inside the borders,
Now
right?
you have to look at the capital flowing across them.
Exactly. And there is a massive column here in the data labeled secondary income, and the numbers are gigantic. Like, are these just foreign aid checks, or is this something else?
It is almost entirely personal remittances.
Okay, meaning what exactly?
This is the diaspora mailing their paychecks home. So starting in the 1970s and 80s, you had this massive migration of Pakistani labor to the Gulf states, Saudi Arabia, the UAE, as well as to the UK and North America.
Right, people looking for better wages.
Exactly. These workers went abroad, earned in foreign currencies, and wired billions of dollars back to their families every single year.
So it's a massive ongoing transfer of wealth from the global economy directly into domestic households.
Yeah. And from a macroeconomic perspective, it acts as a vital, almost structural shock absorber.
Because they run a trade deficit.
A massive trade deficit. They import far more goods, especially oil and heavy machinery, than they export in textiles or agriculture. So those remittance billions essentially plug the hole in the national accounts. They prop up the currency and fuel domestic consumption.
I see. Because when families receive those remittance checks, they aren't just putting them under a mattress, they spend them.
Exactly.
They build houses, they buy retail goods, they pay for private health care, and all of that spending is what drives up that services sector of the GDP we were just talking about.
You've hit on the exact mechanism there. It makes the domestic GDP look fantastic. But it also means that a huge chunk of the nation's economic output is technically, well, an illusion.
An illusion. How so?
Because it is wealth generated by construction booms in Dubai or IT sectors in London being mailed into the local economy. It doesn't reflect the underlying productivity of domestic industries.
Oh, wow. It's like looking at a regional company whose gross revenue is just skyrocketing. You assume their product is dominating the market, but then you look at the ledger and realize their operating costs are eating them alive, their actual product sales are stagnant, and the only reason they're floating is because a wealthy parent company keeps wiring them cash every month to cover payroll.
That is a very precise way to look at it. The capital isn't organic to the domestic industrial base.
So if the macroeconomy is flush with all this remittance cash and the crop yields are technically breaking records, that capital has to land somewhere physical.
Right.
And when you look at the telecommunications and infrastructure data, you see exactly where it landed. The ITU data shows a literal hockey stick graph for digital adoption.
Oh, the story of telecommunications here is one of pure hyperacceleration. Fixed telephone lines grew steadily over the decades, which is normal. But broadband subscriptions and internet user percentages, they went from absolute zero to an explosive, steep upward curve right around 2010. The internet usage population surged past 27% and just kept climbing.
Mobile cellular subscriptions erupted into the multi-millions.
Exactly. It's a remarkable leap.
And alongside that, the electricity access data presents another massive win. The World Bank data shows that urban electricity access hit an impressive 100%. The entire urban landscape is electrified.
And even rural access climbed above 90%.
Which is huge. Building a digital and electrical network across a geographically complex country like that, from the coastal plains of Sindh to the really mountainous terrain up north, that requires massive capital investment, complex logistics, advanced engineering.
It does. The data shows they successfully executed that hard growth.
Here's where the data takes a really dark turn. Because while this society is fantastic at scaling cell towers and stringing power lines, they are seemingly incapable of scaling basic human infrastructure. There is this deeply obscure metric in the dataset. It's called access to clean fuels and technologies for cooking. And it completely shatters the illusion of uniform modernization.
It really reveals a completely different reality.
It does. The data here shows that while electricity is widespread, clean cooking fuel access just lags severely. Nationwide, only about half the population has access to clean fuels.
And the urban-rural divide is stark.
So stark. In urban areas, it's hovering between 65 and 88%. But in rural regions, historically it has remained at abysmal levels, and only recently did it even barely creep up past the 70% mark.
Right.
Which means you have tens of millions of people who might have a smartphone in their pocket and a light bulb over their head, but they're still burning solid fuels like wood, crop waste, animal dung inside their homes just to cook their daily meals.
And here we really have to differentiate between hard infrastructure and quality of life infrastructure.
Okay, what's the difference?
Well, hard infrastructure like telecom networks and power grids is highly monetizable. It operates on a macro scale. A massive telecom conglomerate can erect a tower, sell millions of SIM cards, and generate a massive, predictable, recurring return on investment.
Right, because the consumer buys data packages every month. It's a clean, profitable transaction. Private capital loves a cell tower.
Exactly. But quality of life infrastructure, like laying down natural gas pipelines to remote rural villages or establishing a reliable supply chain for clean cook stoves and liquid petroleum gas canisters, that is a logistical nightmare.
I can imagine.
The profit margins are incredibly low, the distribution network is complex, and the rural consumer often lacks the purchasing power to make it a lucrative market for private capital.
Man, it feels like buying a state-of-the-art smart TV for your living room while your roof is actively caving in and filling the house with toxic smoke.
That's exactly what it is.
And the health implications of that smoke are devastating. The World Health Organization data points out that indoor air pollution from solid fuels leads to severe respiratory diseases, chronic obstructive pulmonary disease, pneumonia in kids, and lung cancer.
It represents an incredibly uneven distribution of the growth dividend. The telecom sector is booming, the digital economy is coming online, but the daily biological reality of cooking a meal remains trapped in the 19th century for a massive portion of the population.
Because the market solves the profitable problems and ignores the unprofitable ones.
Precisely.
The profitable problem is a teenager wanting to stream a video. The unprofitable problem is a mother needing to boil water without permanently damaging her lungs.
And that brings us to the biological toll of this uneven growth, which is perhaps the most sobering part of this entire data set.
Yeah, let's dig into the human capital deficit, because this is the emotional and biological core of this deep dive. We're looking at the World Health Organization and World Bank health metrics now.
And to be fair to the data, we really have to acknowledge the hard-fought progress first.
Absolutely. The improvements in infant mortality are undeniable. In 1960, the infant mortality rate was terrifying. It was 167 per 1,000 live births.
Right. More than 1 in 6 babies didn't survive their first year.
But the recent data brings that down significantly into the 50s, specifically around 50.1 per 1,000. Under 5 mortality also shrank.
And that is a result of global vaccination campaigns, better sanitation in the cities, and the spread of basic antibiotics. Public health interventions kept children breathing.
But surviving is not the same as thriving, and this is where the paradox hits hardest. Because 50.1 per 1,000 means that out of every 20 newborns, one is still facing a life-threatening survival risk.
It's still a heavy toll compared to other lower middle-income countries.
Right. And we mentioned the stunting numbers in the intro. The data shows stunting affecting roughly 40% of children under 5. And wasting remains stubbornly high, with severe wasting hovering around 7%.
And there's another layer to it.
Yeah, the anemia data. We have data showing anemia prevalence in children under 5 at over 53%.
Over half the children suffering from anemia. We really need to define these clinical terms clearly, because they describe very different types of biological trauma, and they explain how this can happen alongside an agricultural boom.
Break it down for us. What is the actual difference between wasting and stunting? Because I think people often conflate the two as just, starvation.
Well, wasting is a measure of acute short-term starvation. It's defined as a child being dangerously thin for their height.
So it's something that happens suddenly.
Yes. It's usually the result of a recent and severe lack of food, or severe acute disease like a diarrheal infection from dirty water that completely strips the body of nutrients over just a few weeks. It is immediate, visible, and life-threatening. When you see images of famine, you are looking at severe wasting.
Okay, and the Green Revolution, that tripling of the wheat and rice yields we talked about, that largely solved the famine problem. It put enough raw calories into the system to keep wasting from becoming an apocalyptic baseline.
Exactly. But stunting is entirely different. Stunting is chronic.
Meaning long-term.
Yes. It is the result of long-term malnutrition. It means a child is too short for their age. But the physical height is just the outward marker.
Right, it's what's happening inside that matters.
Exactly. If the physical body is stunted, the internal organs are stunted, the immune system is compromised, and most critically, the brain is stunted.
This is the concept of hidden hunger.
Yes, because a child cannot build a healthy neural network on wheat alone. Brain development, particularly the formation of myelin sheaths that insulate nerve fibers and allow for rapid cognitive processing, that requires a complex matrix of micronutrients.
Like what?
It requires iron, zinc, vitamin A, iodine, high-quality proteins, and diverse fats. The agricultural system became incredibly efficient at producing carbohydrates. It filled the stomach. But the production of diverse, nutrient-rich foods, like vegetables, dairy, and lean meats, did not keep pace.
Or they remained economically out of reach for the poorest segments of the population.
Ex-
So we solved the empty stomach problem, but we created a cellular starvation problem. The child is eating a bowl of rice every day, so they aren't wasting away, but their brain is literally starved of the building blocks it needs to form synapses.
And it is compounded by the environment.
Yeah.
If you don't have clean water, or if you're breathing in toxic smoke from an indoor cooking fire like we discussed earlier, your body is in a constant state of inflammation.
It is constantly fighting off infection.
Right. And when a child's body is fighting an infection, it takes whatever few micronutrients it has and diverts them away from growth and brain development. It pours them into the immune system just to survive the day.
Oh, man. This points to a massive long-term economic threat. We were just talking about the digital revolution and the shift to a service-based economy.
Yeah.
But if 40% of your children suffer from stunted physical and cognitive development, what does that mean for the country's future? You can't transition to a high-tech knowledge economy if almost half your future workforce has been biologically deprived of their full cognitive potential before they even reach kindergarten.
It is the ultimate invisible ceiling on economic growth. You can lay all the fiber optic cable you want, but if the population using that network has been robbed of their cognitive capacity due to childhood malnutrition, the economic returns on that digital infrastructure will always be fundamentally constrained.
And you can't look at those childhood stunting numbers in a vacuum, because those children make up the base of one of the most extreme population pyramids on the planet. Which brings us to the demographic pressure cooker.
The population dynamics here are really intense. The data reflects an incredibly high youth dependency ratio. At times, this ratio peaked well over 85%.
For anyone unfamiliar with the term, what does dependency ratio actually measure?
It measures the size of the non-working age population, primarily young children relative to the working age adults. A ratio of 85% means you have a massive, towering population of children that need to be fed, clothed, educated, and eventually employed, being supported by a relatively small base of adults.
But in macroeconomics, you always hear people talk about the demographic dividend, like the idea that a massive youth population is a huge advantage. It's what built the East Asian tiger economies in the late 20th century.
That's the theory, yeah.
Yeah.
As a country's birth rates begin to slowly decline, you hit a sweet spot, a generation where you have a massive bulge of young, energetic, working-age people and relatively few elderly dependents and fewer young children.
Right.
If that massive working-age cohort is healthy, highly educated, and has access to capital and jobs, they can supercharge an economy. They earn wages, they put money into savings, banks lend those savings to businesses, businesses innovate, and the country experiences rapid exponential growth.
But looking at the education and health data in our sources, this dividend looks a lot more like a demographic burden. It's a ticking clock.
Because the dividend is conditional. It requires immense upfront investment in human capital, and the education data here is flashing bright red.
Yeah, let's talk about the schools. We are looking at millions of out-of-school children, and the gender gap is staggering. The data indicates that at points, over 5 million girls alone were completely missing out on primary education.
That is an immense amount of lost potential.
And even for the kids who do make it into a classroom, getting them a desk is only half the battle. The World Bank tracks a metric called learning poverty. I really want to highlight this because it's terrifying.
It really is.
Learning poverty measures the percentage of children who cannot read and understand a simple, basic text by the end of primary school, so around age 10. And the data reflects massive shortfalls based on these GAML thresholds. We're talking about reading proficiency failure rates hitting roughly 71% for boys and 68% for girls.
You have to pause and really visualize what that means. If you imagine a classroom or even a chart with 100 kids.
Right, like a matrix.
Exactly. Out of those 100 kids, roughly 70 of them are sitting in a classroom for 5 or 6 years under the supervision of the state, and they are emerging without the ability to comprehend basic written information.
Why? I mean, what is happening in these schools?
Well, the system is plagued by teacher absenteeism, a reliance on rote memorization over critical thinking, dilapidated school facilities that lack basic sanitation, and often children are being taught in a language that is not their mother tongue.
It's like having a massive, powerful engine, your youth population, but you're putting watered-down, contaminated fuel into it by completely underfunding their education and nutrition. Eventually, the engine is going to seize up.
And when we look at the labor force data, we see the immediate consequences of this failure. The labor force participation rate is deeply structurally skewed.
The gender gap here is another canyon in the data. Female labor force participation crawled from around 10% historically up to maybe 22% in recent years. Meanwhile, male participation is vastly higher. There is a persistent 60% gender participation gap.
Let's look at this purely through the lens of economic math. Regardless of cultural context, the math of global development is unforgiving.
Go on.
When female labor force participation is that low, and girls are disproportionately kept out of the education system, a country is effectively benching half of its potential intellectual and economic capital.
You're trying to win a global economic race while choosing to play with half your team tied behind your back.
Precisely.
Yeah.
If you want to move from an agrarian economy to a modern service economy, you need a literate, skilled, and diverse workforce. The services sector requires communication, administration, healthcare, and technical skills.
Right.
If roughly 70% of your youth suffer from learning poverty and nearly 80% of your adult women are outside the formal labor force, the transition to a high-income service economy is mathematically impossible. You simply do not have the human bandwidth to sustain it.
Okay, so let's take a step back and look at the board. We have an agricultural boom that solved famine but isn't providing the micronutrients to prevent stunting. We have a digital boom that wired the country for data but left rural kitchens choking on toxic smoke.
Yes.
And we have a massive population boom that isn't being converted into human capital because the schools are failing and women are locked out of the workforce. The most obvious question any listener is going to ask right now is, why doesn't the state just step in?
That is the crucial question.
Right. If the private market won't lay the gas lines, and the schools need better teachers, and the kids need micronutrient supplements, why doesn't the government just build the schools and buy the supplements?
The answer to that question is found on the national balance sheet. We have to look at the financial albatross hanging around the neck of this economy: external debt.
Oh, the debt numbers are wild. When we look at the macro financial data for external debt, specifically public and publicly guaranteed debt, it is a mountain that just keeps growing. The data shows external debt stocks, or DOD, skyrocketing over the decades.
It's an exponential curve.
It really is. It breaks through the $50 billion marker, then surges past the $100 billion marker, and eventually eclipses $130 billion in outstanding and dispersed debt.
This is the macroeconomic trap that ensnares so many developing nations. We talked earlier about those massive hard-growth infrastructure projects, the telecom grids, the power plants, the highways.
Right.
Those things require massive amounts of capital, and usually they require foreign currency, specifically U.S. dollars.
Because you can't buy turbines from Germany or fiber optics from China using local currency. You have to buy them on the global market using dollars.
Exactly. So the government takes on external debt. They borrow from multilateral institutions like the World Bank or the Asian Development Bank, bilateral partners like other sovereign nations, and private commercial bondholders.
But taking on debt isn't inherently a bad thing, right? Like, if I take out a loan to start a business and the business succeeds, the debt pays for itself.
That is the theory of productive debt. If the debt generates a return on investment that exceeds the interest rate, it's a net positive. But here's where we have to connect the debt data to the human capital deficit we just spent 30 minutes dissecting.
Okay, how so?
Why can't the government build more schools? Because a massive, structurally debilitating chunk of the national wallet is automatically routed out of the country every single year just to pay the creditors.
I'm looking at the debt to exports ratio right now. This is a crucial metric. It measures how much of the money a country earns from selling goods and services to the world is immediately eaten up by debt payments.
And what does it show?
The data shows debt servicing routinely swallowing 20% or more of the nation's total export revenue. At times, it spikes even higher, past 30%.
Think about the physical reality of what that means. For every dollar the country earns on the global market from selling textiles, leather goods, or rice, 20 to 30 cents is immediately wired to a bank in New York, London, or Beijing just to cover the interest and principal on past loans.
Wait, so if they are earning rupees domestically, but the debt must be paid in dollars, any depreciation in the local currency effectively inflates their national debt overnight, even if they didn't borrow another dime.
That is the exact mechanism of the debt trap. They are constantly scrambling for foreign exchange reserves just to keep from defaulting.
It's like a family taking out a high-interest payday loan to fix a leaky roof. But the interest payments are so aggressive that now they can't afford to buy groceries for the kids.
Exactly.
And what happens when they can't afford groceries? They take out another payday loan just to cover the interest on the first one.
In sovereign finance, this is known as a liquidity trap, and you can see it clearly in the data showing extensive use of IMF credit.
Right, the International Monetary Fund.
The IMF acts as the lender of last resort. When a country is facing a balance of payments crisis, meaning they literally do not have enough foreign currency reserves in their central bank to pay their external debts and import basic necessities like oil or medicine, the IMF steps in with emergency loan packages.
But the IMF doesn't just hand over a check and walk away. They impose structural adjustments.
Yes, the IMF's primary mandate is to ensure the country can eventually repay its debts and stabilize its currency. So they require strict fiscal consolidation.
Which means austerity.
Yes. The conditions usually involve raising taxes, cutting government subsidies on things like fuel or electricity, and slashing public spending to balance the budget.
And when a cash-strapped government is forced to slash public spending overnight, what gets cut first?
Almost always, it's the soft infrastructure. Education budgets are frozen, public health care initiatives are delayed, nutritional programs are scrapped.
The very things we just identified as the absolute critical missing pieces for long-term growth. They are cutting the foundation of their future economy just to tread water today.
It is a vicious, self-perpetuating cycle. You are using new emergency loans just to stabilize the currency and pay off old loans. There is absolutely no fiscal space left to invest in human beings.
Which brings up a really tough question about those massive infrastructure projects we talked about earlier, the ones that drove the debt up to $130 billion.
Right.
Are they actually generating enough economic return to pay for themselves, or are they just concrete monuments adding to this debt pile?
Well, that forces us to look at the governance indicators data included in our sources, specifically the Worldwide Governance Indicators metric for control of corruption.
Okay, let's look at that.
Now, looking purely at the definition of the data, this indicator captures perceptions of the extent to which public power is exercised for private gain. This includes both petty and grand forms of corruption, as well as the capture of the state by elite interests.
When a country is pouring tens of billions of dollars of borrowed money into massive infrastructure projects, the governance environment dictates the efficiency of that capital.
Exactly.
If the perception of corruption is high, it implies that a significant portion of that borrowed money is lost to inefficiencies, kickbacks, cost overruns, or private capture.
Which means the national debt goes up by $1 billion. But the true economic value of the highway or power plant actually delivered is only worth, say, $600 million.
So the asset physically exists, but because it was built inefficiently, it doesn't generate the expected economic return, which means it cannot service its own debt.
Right. So the burden falls back onto the general taxpayer.
But the general taxpayer is struggling with 40% childhood stunting and 70% learning poverty, so their taxable income is incredibly low. The tax base is too narrow.
So the government has to borrow more or cut services more to make up the difference. It is the math of an unsustainable equilibrium. The debt crowds out human development, and the lack of human development ensures the economy can never innovate its way out of the debt.
Okay, that is incredibly heavy. We've covered an immense amount of ground, from the cellular level of malnutrition to the macroeconomic scale of sovereign debt. I want to bring all these disparate data points onto a single conceptual scale to really synthesize this paradox.
A visual metaphor is probably the best way to understand the structural imbalance.
So imagine a massive set of scales, like a big scale of justice. On one side, we pile on what we can call hard growth. We put the GDP volume on there, zooming from under $4 billion to over $300 billion.
Right.
We toss on the crop production index, tripling the wheat and rice yields. We add the millions of cell phone subscriptions, the 100% urban electricity grid, the soaring skyscrapers, and those massive remittance inflows. This side of the scale is incredibly heavy. It looks dense, metallic, and highly successful. It is the triumph of macroeconomics.
But then on the other side of the scale, we put human capital, or soft power. We put the quality of the education system heavily weighed down by a 70% learning poverty rate.
Yeah.
We place female labor participation struggling in the low 20s. We add access to clean cooking fuels virtually non-existent in the rural areas. And finally, we place the childhood nutrition metrics burdened by 40% stunting and severe hidden hunger.
That side of the scale is dangerously light. It lacks mass. It lacks density. And looming over the entire mechanism, pressing down on the gears of this scale, is a $130 billion anvil of external debt, ensuring the scale can never balance out.
What this dataset so clearly outlines is a growth paradox's logical loop. You simply cannot sustain hard growth without soft power.
Because eventually the physical infrastructure requires a highly capable society to maintain it and innovate upon it.
Exactly. A digital economy requires healthy, educated, highly skilled workers to write the software, manage the logistics, and drive the consumer demand.
Right. You can build a 5G network, but if the population can't read past a basic level, the network is just a very fast delivery system for low-value content. It doesn't generate the high-value intellectual property that transforms a developing nation into a developed one.
The physical infrastructure is just the scaffolding. Human capital is the building itself. If you only build the scaffolding, eventually the wind blows it down. The only way to break the cycle of debt and low-quality growth is to undergo a radical paradigm shift. The pivot must be away from an obsession with macroeconomic scale-chasing, total GDP numbers, and concrete megaprojects, and toward an absolute obsession with human capital investment.
It means making the invisible visible. It means caring as much about the micronutrients in a child's brain as you do about the megapixels in their smartphone camera.
Exactly.
It means judging a government not by how many miles of highway it paved, but by how many girls it kept in school through the 12th grade.
It is the only pathway to long-term solvency. You have to translate the agricultural boom into dietary diversity. You have to translate the population boom into an educated, fully gender-inclusive workforce. Otherwise, the paradox will eventually collapse in on itself under the weight of the debt.
We have been on quite a journey today. We started this deep dive looking at a booming agricultural index, a picture of absolute abundance. But as we peeled back the layers of the World Bank, WHO, and IMF data, we uncovered a complex interlocking web.
We did.
We saw how a country can leap into the digital age while leaving its rural kitchens choking on the smoke of solid fuels. We learned that remittances can act as a massive shock absorber that masks underlying domestic economic weakness.
And most importantly, we learned the clinical difference between an empty stomach and a starving cell. We saw how a rising macroeconomic tide does not automatically lift all boats, especially if those boats have structural holes in them.
To close us out, I want to leave you with a final paradigm shift to ponder. We spend so much time in our culture watching stock tickers, GDP growth charts, and export volumes. We celebrate the time-lapse videos of skyscrapers going up. But the expert here raised a question that I can't stop thinking about.
If a country's GDP goes up, if its crop yields double, and its skyscrapers touch the clouds, but its children's cognitive and physical development does not grow alongside them, are we using the completely wrong metrics to measure global success?
It really makes you wonder.
Next time you see a glowing headline about an emerging market's explosive economic growth, don't just look at the stock market. Ask yourself, yes, but how tall are the children?
That is the ultimate metric. Thank you so much for joining us on this deep dive. We encourage you to take this framework, this critical lens we've built today, and look at the data of your own country, your own community, look past the macro mirage and ask the hard questions about human capital. Until next time, keep digging into the numbers.